Now back to one of our top stories today. The Bank of Canada has raised the overnight interest rate again. It announced a 50 basis point hike, and that was the high end of estimates. That takes the overnight rate to 4.25%. Scott Peterson is monitoring this story for us. So what's the takeaway from the central bank announcement this morning?
The takeaway, Arthur, is that inflation is still a serious concern for the Bank of Canada. This is the 7th consecutive rate hike by the bank, one of the most vigorous and aggressive rate hike policies going back since the spring in the history of the bank. And when you consider that we're at 4.25 now, as you mentioned, we're at 0.25 at the beginning of the year to show you how dramatically these rates have come up. So Tiff Macklem, the bank, has had a good argument for going at the 50 basis points rather than 25 basis points today, because the economy is still chugging along. Inflation has come down a little bit at 6.9%, not nearly as much as he wants it to come down, but we're still seeing employment at low levels, and so that means the economy is still strong enough to withstand these big rate hikes. But there's a lot of downtime here as far as trying to see when the effects will take place for the economy. A lot of economists are saying that these effects already initiated with the 50 basis points today won't be felt until well into next year. So this is another aggressive rate hike, and Tiff Macklem has indicated that he wanted to go very strong at the beginning of this rate hike cycle in order to conquest the inflation rather than to have to do these dramatic moves next year, I think.
And the rate being the highest it's been since 2008, we also know that language is important in these Bank of Canada releases. So what signals has the bank given as to what the future looks like, Scott?
Yeah, the bank has looked into the crystal ball and said that it looks like they're signaling a pause in interest rate hikes. For example, back in October, they said that interest rates will need to rise further, and this morning in the current release saying that the Bank of Canada will be considering whether the policy interest rate needs to rise further. So this is a signal that maybe these big rate hikes are done. There's some economists now thinking we could see a 25 basis point hike next month in January, but there could be a signal here that there's a pause, a wait-and-see moment where the Bank of Canada wants to see the effects already of this dramatic rate hike today and up to this year.
Thanks for this, Scott.
Right.
So we do want to stay on this story, and we've reached Jean-François Perrault. He's the Senior Vice President and Chief Economist at Scotiabank. Thank you for joining us today.
Thank you.
Okay, so what's your reaction to this latest hike?
Well, it's very similar to, I think, the reaction that Scott just indicated. It's obviously, it's a little bit more aggressive than the market had been anticipated. It's in line with what we were expecting, but that's kind of secondary. I think the really big news here is, that they are signaling a pause. The question is, is it a temporary thing? Is it a more permanent pause? We'll see. But I take a lot of comfort from the fact that they believe, certainly it looks like they believe, like they've done enough. And they're just waiting to see if, in fact, that's true. So they'll look to inflation readings in the next several months, economic activity readings for the next several months, and then decide if they need to tweak that policy at some point next year. But it is, I think, pretty good news that we are at a point where they believe that they're not sure if they've done enough, or they think they've done enough, and they're not sure if they need to keep going, which is a very different message than what they've been communicating for the last several meetings.
I mean, you wouldn't be able to fault Canadians who might be having a difficult time seeing that there's good news on the horizon, because contending with the 7th consecutive rate hike, it has had a real impact on Canadians and businesses. Tell us a little bit about how it's even though it's supposed to be helpful, doesn't feel that way.
Well, I mean, that's the problem with inflation, right? The cure to inflation is to harm people, is to harm the economy. That's how you get inflation down. And that's what they've been trying to do. So, the higher interest rates that we observe, obviously a big impact on mortgage rates, big impact on the housing market, big impact on people's budgets, but so has inflation been pretty negative from that perspective as well. So the idea with the rate increases is, they're trying to slow things down to ultimately make us better off, and that we control inflation and rates can come back down. And unfortunately, it's hard medicine to take. There's no doubt about it. Nobody likes what's going on. It's necessary, and hopefully almost over, if not over, but we'll see.
And now, in terms of looking ahead to the future, which of course we know economists love to do, wondering about 2023, in order to rein in inflation, we know that remains at 6.9%. What do you think we might expect to happen over the course of that year, despite talking about the hold that appears to be on the horizon?
Well, listen, I mean, part of the reason the bank is slowing, stopping, pausing its rate increases is because we know that this is going to cause a slowdown. The question really is, how much of a slowdown are we going to see? Is it going to be a recession? Is it going to be a mild recession, a big recession? We think it'll be a mild recession and more of a pause, but we'll know that in the next several months. And that's really the critical thing. As you think about next year, the risk has been for quite a while that the Bank of Canada might have overdone it. That in the fight to inflation, that the cost to the economy needs to be so large that you trigger a large recession. Now, we don't think it's going to happen, but that is certainly what we're going to be experiencing in the first part of the year. Weakness relative to what we've seen last year. And hopefully that weakness is reasonably transitory so that by the second half of the year, we find ourselves on a bit of a growth path, not on a dramatic growth path, but, coming out of the recession. And through that period of time, lower inflation. And hopefully by this time next year, the Bank of Canada will be in cutting mode again and trying to slowly bring interest rates back down to what are more neutral levels of the, in the 2 to 3% range over a long period of time, of course.
Now, to your point, what many people do, what I think all of us do, is we, of course, compare to what's been previously experienced, either personally or as a country. We talked about the rates being the highest since 2008. I'm reading here, Canada's yield curve reached its steepest inversion since the early 1990s, which was right before the economy fell into a deep downturn. So how challenging could the next 12 months prove to be?
Well, listen, I mean, there's no question that we're in for a slowdown. That is, I think, baked. I think when you kind of go back and compare to history as a point of reference for how bad things are going to be, there are a couple of things that are really important to try and form a judgment there. One is the strength of the labor market. Our labor market is unbelievably strong still. There's over 1 million vacancies, roughly 1 million vacancies. Firms are likely going to hoard labor as they go forward because it's so difficult to attract and retain that it's going to mute the employment response that we typically see in big recessions relative to history. So that's one thing. The other is, despite the move in house prices, despite the fall in asset values, the reality is that consumer balance sheets and firm balance sheets are still in reasonably good shape, which is a pretty significant contrast to some earlier historical periods. So those two things suggest to us that, the weakness is likely to be moderate, because you've got these big factors that are pretty divergent relative to history, and that gives us some degree of confidence that we're going to be able to manage this with minimal economic harm. But again, that's I'm not going to say there's a hope and a prayer there, but there's certainly a bit of hope.
Well, thank you for your time on this. That is Jean-François Perreault. He is the Senior Vice President and Chief Economist at Scotiabank. Thank you.